The truth is exposed. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the data was all faked, and the reason this is important is because the government doesn't want you to know the truth. Because if you did, you'd realize that the U.S. economy is in far worse shape than it is. And the problem is that consumers, businesses, and even investors make decisions based on inaccurate data. And right now, investors are making one of the biggest mistakes in their lives. But it's not just them, as you're about to see, it's the policymakers who are also making bad policy based on this bad information that is about to send the U.S. economy spiraling into a deep recession. Plus, we have a sponsor of today's show. We'd like to welcome Safe Harbor Financial to the show. You can find them on the NASDAQ under symbol SHFS, and they are a cannabis banking services company, and they've been around since 2015, and they have facilitated over $23 billion in deposit transactions in over 41 states. And with cannabis expected to be legalized in more states, it's going to be a boom for Safe Harbor's business and their stock price. I'm going to show you an incredible chart setup. I'm going to show you where to buy and where to sell Safe Harbor so you can realize a 14% gain. Stay tuned to the end of the show or check out the pinned comment or description for more information now. Let's head over to Bloomberg, where we picked today's story up. But the U.S. job openings declined to the lowest level since January 2021. And one of the problems with the JOLTS survey, it's one of the most inaccurate pieces of data that's put out by the government. And yet, when we look backwards, former Fed chair, who is currently the Treasury Secretary, Janet Yellen, this is her favorite data series. What is showing us now is the U.S. economy is in far worse shape than we thought. And if the data was accurate, well, we can only imagine what the truth would be. As available positions now decreased to 7.67 million from a downward revised 7.91 million reading in the prior month. This according to the Bureau of Labor Statistics. The figure was lower than all estimates because everybody is buying into the narrative that we are going to achieve, with the delay, the soft landing or no landing scenario, and that all we need is just a couple of Fed rate cuts. The problem is investors have been making decisions based on inaccurate data, have piled aggressively into equities. Consumers are still borrowing and spending instead of saving, and even businesses are building up inventory. But what we're about to see is a U.S. labor market, as I talked about in yesterday's show, is in far worse shape than anyone believes. The decline in openings coincides with the recent data that show the labor market is slowing, which has raised concern among Federal Reserve officials. Job growth has been slowing, unemployment is rising, and here's the big one: job seekers are having greater difficulty finding work, fueling fears about a potential recession. The fear is we're entering stagflation, and what we know is when we enter a period of rising prices and rising unemployment, it's a foregone conclusion that we will have a recession. And this is why we're suddenly seeing a change in tone in Federal Reserve officials, because they've realized that in order to bring inflation down, they've had to sacrifice the one thing they didn't want to, and that was a labor market. Let's take a look at this chart here. We have job openings. This is the JOLTS survey against the unemployment rate. So why it was not expected by experts we would see the JOLTS survey continue to go down, I can show you with a near mirror relationship, the U3 unemployment rate in red against the JOLTS survey in blue. And it's very clear that where the unemployment rate goes, job openings follow. And this makes perfect sense, because the longer people are on unemployment, well, it means they can't find another job. That means, of course, we see job openings start to decrease. The problem is the actual data that goes into the JOLTS is terrible. It's actually some of the worst data you could see, and perhaps the real truth is there's far fewer job openings available than what the government believes. And we can look at continued unemployment claims in red, because we've noted that tends to be where we see continued claims go, the U3 unemployment rate follows, and then of course following that is the JOLTS survey, which is rather lagged between the two. But you can see here again a near mirror relationship suggesting that as continued claims go higher, we're going to see the unemployment rate go higher, and we're going to face fewer and fewer job openings, because it makes perfect sense. If people are on unemployment and can't find another job, that means there isn't as many job openings as the government believes, because if there were, people would go on unemployment and then eventually find another job. Right now, we're seeing just about the number of new people entering unemployment get another job and come off unemployment, but it's not enough to change the trend, which is soon to get worse. As policymakers have made it clear they don't want to see further cooling in the labor market and are widely expected to start lowering interest rates at their next meeting in 2 weeks, the only question being by how much. And after July's disappointing jobs figure and a large downward revision to payrolls in the past year, Fed officials and market participants are paying close attention to the August employment data due this Friday, especially if another weak report could prompt an outsized rate cut. And while we don't buy into the non-farm payroll report because we know its inaccuracies are very notable, we see that the JOLT survey is even worse. And when we look at the two, we can tell you with relative certainty that the non-farm payroll report is not going to be a blockbuster one. But let's first look at the Fed's policy mistake, because if we knew the truth, if policymakers knew the truth about the data, then they could make better decisions. This chart really validates that. As we go back and look at the policy of the Fed in terms of where they're driving the funds rate, we can go back here into around 2007 into 2008, and you can see the JOLT survey peaks and starts to roll over, and that signals the Fed that perhaps the labor market's starting to fall apart. And you notably see they cut rates right as the JOLT survey is going down. Once again, that Fed Chair Powell, now this time he does it around 2019. You see the JOLT survey starting to slow down, indicating economic weakness. What does he do? He cuts rates. Now let's fast forward to where we are now. Remember, the Fed said we need to get rid of inflation here. They kept rates elevated. They continue to drive them higher. All the meantime, the JOLT survey continued to plummet based on their past response. The Fed should be cutting here, which indicates they're absolutely late to the game. Of course, that matters if you actually believe that rate cuts actually do something. And I'd love to hear your feedback. Weigh in the comments. Do you think Fed rate cuts will turn the labor market around, or do you think they're worthless? Let me know in the comments. While you're there, check out Safe Harbor. They're on the NASDAQ under the symbol SHFS in the description or pinned comment below. Because when we look at the non-farm payroll report, now mind you, I had to cut off the pandemic data because it skews this and you would not be able to see the relationship, but it's very clear. Where job openings go, the non-farm payroll report tends to follow. You can see it very clearly here going into the global financial crisis. Perhaps this is one of the reasons why it's one of Janet Yellen's favorite data series, as noted, but the problem is the actual data is so inaccurate. But forecasters in Bloomberg see a hiring pickup and the unemployment rate dropping. Well, I disagree with that, and I'll show you the evidence. And that means Treasury yields dropped and the S&P 500 was lower after the report, because the market is starting to realize that the Fed made a massive mistake, that to quell inflation, they're driving the U.S. economy into recession. That means interest rates need to go down, financial conditions are going to tighten, and it also tells us that investors who have piled in to the top 5 to 7 mega tech stocks have been making one of the worst investment decisions in their life, or at least we'll find out soon enough. Because as we know here, now turning to Zero Hedge on the same topic, keep an eye on construction jobs, because if indeed the economy is going to turn around, we should see a boom here. But the number of job openings in this sector is an absolute free fall, plunging to levels not seen since late 2020. Keep in mind, we're coming out of the pandemic at that time. But look at this, and here's the most shocking chart of the year. Construction job openings, that's shown in red, against construction jobs. Expect nothing less than an epic implosion of construction jobs in the coming months as the green line looks to chase that red line lower. That is telling us what we do know is this data is not good. We've seen businesses making bad decisions. We see investors making bad decisions. I'll show you that chart in a moment. And consumers leveraging up with debt under the belief that everything would turn in their favor. But finally, no matter what the data shows, let's not forget that it's all just estimated. That's the problem here. And it's safe to say the real number of job openings remains far lower, since half of it, or some 70% specific, is actually guesswork. As the BLS itself admits, while the response rate to most of its various labor and other surveys has collapsed in recent years, nothing, that's right, nothing is as bad as the JOLTS report, where the actual response rate remains near a record low of 33%. The only question remaining, why aren't businesses responding? Well, it's perhaps because the data is actually worse than what they want to report. Maybe they don't want the government to know that there aren't really any of these job openings out there, because again, if they were, we would see evidence showing that people were coming off continued unemployment claims at a higher clip and businesses were hiring. Instead, we're seeing the exact opposite. And what this is setting up is one of the biggest mistakes for investors in their lives. As we look at the relationship now here between the JOLTS survey in blue and the NASDAQ 100, and I did the chart specifically this way so you can see just the difference here. When you start to see job openings come down, well, what it means is stock prices are going to go down with it. And you can see that relationship in the dot-com bubble. You can see it in the global financial crisis. You can even see it kind of right in here around 2015, 2016, where JOLTS starts to slow down, and even leading into the pandemic. But here's the big problem. Right now, investors are mega bullish, buying every dip, chasing equity prices higher, believing that we are at the cusp of the next great bull market. And the JOLTS survey is telling us we are very clearly headed right into a recession, and that means at some point there's going to be a massive mean reversion in equities, meaning if you're looking to make money in the markets, you have to be strategic, and one of those options could be Safe Harbor Financial. Check them out on the NASDAQ under the symbol SHFS. I'm going to show you an incredibly easy chart set up to trade, because let's talk about the economy now, as Dollar Tree cuts the outlook on muted consumer spending. So if we're going to see a turnaround in the economy, what we'd want to see is companies like Dollar Tree and Dollar General saying that they're booming, that they're going to open more stores, that they need to hire more staff. Instead, we're seeing the exact opposite. And like its peers, Dollar General, Dollar Tree is facing longer-term challenges. Its core customers are under pressure from high inflation and interest rates, and in reality, they're under pressure because their wages and the amount of hours are not keeping pace. And while challenging economic times have historically lifted their business, dollar stores are now facing heightened competition from Walmart, Aldi, and other retailers focused on low prices. This caused Dollar share price to plunge the most on record last week. The company, which operates more than 16,000 stores, said earlier this year would close about 1,000 underperforming stores, sending many workers to the unemployment line, and hope to improve profitability and focus on more favorable opportunities. And just yesterday, we talked about how Volkswagen was looking at closing a plant. I said this is coming to America. Here you can see they're looking at closing stores, and they're not going to be the only ones. You're going to see a lot of other retailers do the same thing, because during the boom time, they borrowed a ton of money to buy their stock back and do other things. They're loaded up in debt, and they're going to have to trim expenses, and that means it's going to be at the expense of the American worker when they start closing stores. You'll see it's coming soon. And the Fed, well, they're starting to change their tune, as Bostic now says the risk to the Fed's jobs and inflation goals are now in balance, and it wasn't long ago they were saying they were out of balance, but suddenly there's been a change. It's because the labor market's falling apart. And look, you're going to see they don't want to admit it, but this is all now setting up a 50 basis point cut in September. And once that happens, watch out. There's going to be a whole lot more that follow. Although they have declined significantly, risks to meeting our price stability mandate remain. Bostic goes on to say we must stay vigilant to ensure those risks continue to wane. The reality is, when you have plunging JOLTS data, Mr. Bostic, you're not going to see inflation. What it's telling us is the labor market's falling apart, and people on unemployment don't have the money to spend. You don't get inflation. You get stagflation, but that doesn't last. And history shouts to us that loosening monetary policy prematurely is a dangerous gambit that can rekindle inflation and entrench it in the economy for many months or even years, he said. The problem is, again, it all is about the labor market. In examining labor market data and anecdotal information, Bostic says he sees a, quote, loosening but still broadly stable jobs market. The problem is he doesn't seem to understand. It's slow at first and then all at once. It's like a bear market in stocks. It starts slowly and then next thing you know, accelerates. The same thing is true to the labor market. The problem is this is all starting to happen as we head in this holiday season, which is a time we know that retailers need massive amounts of business. As we head into the Black Friday season, they hire a lot of people, but if there's no demand, they're not going to hire, and that means we're looking for a holiday bust to come. And labor market continues to weaken, he said, but it's not weak. Well, it's getting there and quick. And rest assured, I do not sense a looming crash or panic among business contacts, despite the fact that the Fed regional surveys suggest otherwise. However, the data in our grassroots feedback describe an economy and labor market that's losing momentum, and that's the problem. It's just like the equity markets. Once you start to lose momentum, it's slow at first and then all at once. And here's the evidence things are going to get worse. Perhaps Bostic just can't see the reality. And again, you look at the regional Fed surveys, you look at the ISM data, it's very clear. When you look at total compensation growth, this is average hourly earnings, which we note employers don't have to give out as big of wage gains because there's more and more people on the unemployment line, and there's less and less work for the workers they have to do. The other issue, we multiply this by average weekly hours. That's the other move that employers are making. They cut hours. Put those together, you've got total compensation growth shown in red against the JOLT survey. And what do you see? That's on a year-over-year rate of change. When you get a deceleration in total compensation that's matched with a declining JOLT survey, well, you see this gray shaded bar. It tells you headed right into recession. We were headed into one going into the pandemic, but that threw everything off. It's very clear we're headed into one now. There's only one time we can really see clearly here. You get this deceleration, but the JOLT survey was rising. No recession there, but this time it's very clear what's coming. And we turn to China, where we see the services sector starting to implode. Remember, what's happening there is coming to America as China services expansion cools and a new sign of economic weakness. As we know, that the cakes in China's services purchasing manager index fell to 51.6 in August versus 52 the previous month, indicating that the expansion of the services sector is slowing to that of crawl speed. Competition in the sector was still fierce, and boosting sales through price cuts became a priority for businesses as surveyed companies adopted a cautious approach to hiring to save costs, leaving labor market under pressure. Again, this is all coming to the United States and in a big way. Remember, where manufacturing goes, services follow, and when the summer months come to an end, so too is the U.S. labor market. The findings add to a picture of an economy still at risk of stalling, as official data published over the weekend shows service industries from restaurant to tourism near contraction during the last month of summer. The sector that is at the center of the piecemeal government action to revive consumer demand is weighed down by a prolonged real estate crisis that's not getting any better. And the outlook for the country's $17 trillion economy still hinges largely on the prospects for manufacturing and exports, which are all in contraction all around the world, even as new hurdles emerge to their expansion. China's factory activity contracted for the fourth straight month in August, the latest sign that the world's #2 economy may struggle to meet this year's growth target of around 5%. But what we see happening there, and again, is coming to America in the not too distant future as we watch the labor market here come unwound. But one place you can look for your investment targets potentially is Safe Harbor. I'm going to show you how to realize a possible 14% return. Show you where to buy them. I'm going to show you exactly where to sell. You can find them on the NASDAQ under symbol SHFS. Let's take a look at Safe Harbor, because they are navigating steady success in the cannabis business. And Safe Harbor is a fintech platform with a stellar 9-year track record of facilitating traditional banking and lending services to the U.S. cannabis industry through a network of financial institution clients. And they are the first NASDAQ-listed company with a compliant cannabis finance infrastructure. They've got expertise in the cannabis banking and lending, leveraging a proprietary fintech platform. They've got leadership and expert position in an underserved market with high barriers to entry and regulatory oversight. And they've got a national footprint in 41 states, facilitating over $20 billion in deposit activity. And they've got tremendous organic growth opportunities in the merger and acquisition space, commercial lending, and cannabis industry consolidation, setting up a potential investment in Safe Harbor. to be worth considerably more than it is now. Again, I'm going to show you a fantastic chart setup. Again, check them out on the NASDAQ on the symbol SHFS. And many traditional financial institutions will not bank cannabis-related businesses. This is setting up high risk and high barriers to entry, meaning less competition, more profit, and more revenue potential for safe harbor. And we're talking about revenue performance here. You can see the year-over-year revenue reported is up 85% between year 2022 and year 2023. Their quarterly reported revenue continues to be stable at over $4 million. This is excellent news because they're looking to scale. Their present revenue streams include investment income on deposits, lending fees, deposit account compliance and onboarding fees, transaction fees, and program licensing. And they're looking to expand into new loan options, loan participation fees, loan underwriting, direct payment processing, insurance products, and direct vaulting and courier services. And their growth as an expansion is looking to get even bigger. As you see here, their established national footprint of about 41 states, looking to see that expand as more states legalize cannabis. And they have many competitive advantages as they have consistent performance. They have lending and depository service access, low cost of funds advantage. They have the expertise in cannabis, brand recognition, proprietary, stable fintech and compliance software. They've got the high risk barriers to entry to keep out competition. They've got regulator acceptance and multiple growth opportunities that we just talked about. But let's take a look at their growth strategy because they're looking to expand organically. They're looking to see bulk acquisition of client relationships, new commercial lending opportunities, mergers and acquisitions. They see opportunity in the current legal markets and the legalizing markets. But let's take a look at their recent press release as they reported their financial reports for the second quarter and 6 months ending June 30th, 2024. Their net income increased $0.9 million in the second quarter of 2024. Their loan interest income increased 203.6% year on year. And excluding impairment expenses in 2023, operating expenses decreased a whopping 34.5% versus 2023. They've got cash and equivalents increased 25% to $6.1 million. And check this out, their adjusted EBITDA increased 14.5% to approximately $0.97 million, compared with approximately $850,000 for the second quarter of 2023. This is a company that's making waves in a space that other people can't compete, and that's what sets up an incredible opportunity to invest in their stock. Let's take a look at this recent chart here because I want you to see an investment right here around this 55 to 57 cent level. You can see is an area of support where buyers step in, and you notice this red bar here. This is a volume profile line. This is 65 cents. You notice the stock jumps right up there, and there's your sell target. That's where the sellers are at. You want to look to be buying right around this 55 to 57 cent range and look to sell right here around 65 cents. That would put about a 14% return in your pocket. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.